Welcome to Talk Tickers. We dive deep into market-moving events, and today, well, we're digging into Home Depot's Q2 2025 earnings call.
Yeah, it's a good one to unpack.
Absolutely, because, when these calls happen, everyone jumps on the headline numbers, the big wins, the misses.
Right, the immediate reaction.
But the real story, the strategy, that often lies a bit deeper in the nuances, and that's what we want to get into for you today.
Couldn't agree more. And what's really fascinating here is how the market reacted. It was surprisingly strong, wasn't it?
It really was.
Despite some apparent misses on the top line, the stock actually rebounded significantly. That tells you investors saw something more profound going on.
Okay, so let's lay out those headline numbers first, get the basics down. Q2 2025 total sales hit $45.3 billion.
Which is up 4.9% year over year. Pretty solid.
Yeah. And consolidated comparable store sales, that's the key metric for existing stores, they were up 1.0%.
With the U.S. slightly stronger, up 1.4%.
Okay. Then profitability. Yep, EPS, $4.58 up, basically flat compared to last year.
Right. And the non-GAAP, the adjusted number, came in at $4.68. That was just a tiny bit below consensus estimates.
And overall revenue, $45.28 billion, also just fractionally missed expectations.
Exactly. And you saw that reflected immediately, right? Pre-market, the shares dipped.
Down about 2%, yeah.
But then things totally changed during the trading day. The stock surged.
How much did it climb?
Ended up somewhere between like 3.1% and 3.9% higher. Even hit a 6-month high, I believe.
Wow. Okay, so that's not just market noise.
No, not at all. It means the market looked past those slight misses very quickly and found a stronger narrative. Resilience, strategic moves.
So let's get into that stronger narrative.
Yeah.
What were the pivotal financials and operational points that drove that shift? You mentioned U.S. comparable sales improved sequentially.
That's right, and this is really key. Forget the overall 1.4% for a moment. Look at the trend within the quarter.
Okay.
May was up just 0.3%, June, a little better, 0.5%, but then July.
What happened in July?
Big jump, up 3.3%. That acceleration through the quarter, that's significant.
Okay, so what's behind that? What caused that pickup, especially in July?
Well, according to management, it was really broad-based. They called it the strongest performance in over 2 years.
Strongest in 2 years. Across how many areas?
12 of their 16 merchandising departments showed that strength. So it wasn't just one thing.
Interesting. So what's the dynamic? Are people doing big renovations again?
Not quite. That's the crucial point. The bigger projects, the ones needing financing, those are still largely on hold. Interest rates are high. There's economic uncertainty.
Right. Makes sense.
But what is happening is that customers are tackling smaller projects, things they can maybe pay for out of pocket or just feel more comfortable doing right now.
Like what kind of projects?
Think backyard improvements, maybe painting, smaller bathroom updates, that sort of thing. Stuff that doesn't necessarily break the bank, but improves the home. It shows a core resilience.
Okay, that makes sense. And yet, big ticket transactions over $1,000, they actually rose 2.6%. How does that fit?
Yeah, it's a bit of a counterpoint, isn't it? It suggests that while huge projects are paused, some larger purchases are still happening, maybe essential replacements or specific proactivity.
And online sales jumped about 12% year over year. That's a big number.
It really is. And that's directly tied to their tech investments, especially in the last mile.
Ah, the delivery piece.
Exactly. They've rolled out new machine learning models like one called Ship from Best Location. It's apparently led to the fastest delivery speeds in company history.
And customers are responding to faster delivery.
Definitely. They noted a double-digit lift in spend from customers who use those faster options. Convenience pays, clearly.
Okay, what about margins, gross margin?
Held steady, 33.4%, right in line with what they expected. Shows good cost management.
And operating margin?
That was 14.5%. A little lower than the 15.1% in Q2 last year.
Reflecting investments.
Precisely. And return on invested capital, ROIC, that was 27.2%, down from 31.9%. Again, you see the impact of those deliberate strategic investments they're making.
Like building out the pro ecosystem.
Exactly. Inventory turns were also slightly down, 4.6 times versus 4.9 last year, which again kind of points to building up capabilities, especially for those professional customers.
Right. You mentioned the pro ecosystem. It sounds like that's a huge focus. Can you elaborate on what they're doing there?
It's central to their growth plan. Right? They are intensely focused on the professional customer. And it's not just one thing, it's a whole strategy.
Okay.
They're building what they call a unified capability set, trying to create a seamless experience for pros.
How? What are the pieces?
Well, acquisitions are a big part. Remember SRS Distribution? roofing, landscape, pool supplies.
Mm-hmm.
They bought them over a year ago.
Right. How's it going?
Apparently exceeded expectations,
Yeah.
driving really strong growth and helping their organic efforts too. That adds 1,200 locations, thousands of associates, 8,000 trucks. It's significant scale.
And they have another deal pending, right? GMS.
Yeah, GMS.
Yeah.
That's specialty building products, drywall, ceilings, things like that. It's complementary to SRS.
So broadening the offering again?
Exactly. It adds another key vertical for pros working on complex projects. More distribution, more services across the U.S. and Canada.
So it's about having everything the pro needs, but is it also about making it easier?
Absolutely. That's where the integration and technology come in. We talked about the last mile delivery tech.
The machine learning, ship from best location.
Right. But they're also using tech in the stores. These order fulfillment associates, OFAs, they have enhanced HD phones now that direct them efficiently for pro orders.
Streamlining the pickup process.
Yeah. And then there's trade credit. They've signed up several thousand pros already.
And is that making a difference?
Apparently so. They're seeing a double-digit lift in their spend from pros using trade credit. And the plan is to make using it in-store seamless.
Sticky. Makes it harder for pros to go elsewhere.
Very sticky. Plus improvements to the order management system, inventory reservation, order modification, invoice upon delivery, things pros really need.
So, connecting the dots. This unified system, the goal is to make Home Depot the easiest, most comprehensive place for pros to shop, right? Consolidate their spending.
That's exactly it. Gain market share by being the indispensable partner. It's a powerful strategy, almost like becoming the Amazon for pros, like you hinted at earlier.
Yeah, with that deep category knowledge and physical presence.
Right. But we do need to temper this with the macro environment. Management was clear about that.
The headwinds are still there.
Yes. Elevated interest rates, economic uncertainty, they persist. Big projects are still on hold because of that. And the housing market.
Still weak.
Turnover is at like a 40-plus year low. That's a significant drag on major renovations.
Okay, that sounds pretty tough. But didn't management also say their customer base is very healthy?
Yeah.
How do those two things square up?
It's a good question.
Yeah.
Their point is that the underlying financial health of many homeowners and pros is still strong.
Meaning?
People are generally employed, incomes are up, and home equity is massive. Remember, home values appreciated significantly since 2019.
Right, something like 50%.
Yeah, translating to about $11 trillion in tappable equity nationally. So the argument is customers have the capacity for bigger projects.
They're just choosing not to right now, deferring, not canceling.
That's the bet management is making. They believe the demand is deferred, waiting for better conditions or more confidence.
So what could actually trigger that? What gets those larger projects moving again?
Well, the big one is mortgage rate relief. If we start seeing indications that the Fed might ease rates, maybe hints coming out of events like Jackson Hole.
That could be a catalyst.
The major one. Also, don't discount things like the recent tax package, lower taxes, increased child tax credits, bonus depreciation for businesses.
That could free up some discretionary spending.
Exactly. It could provide just enough of a nudge for some of those deferred projects to get going.
Okay, let's switch gears slightly. Tariffs, always a factor in retail. How is Home Depot handling that?
Well, first off, it helps that over half their products are sourced domestically. That gives them some buffer.
Right, less direct import exposure.
But for imported goods, where tariffs did increase, they saw some modest price movement. They mentioned garden chemicals as an example.
So they just pass the cost on.
Not necessarily across the board. They use what they call a portfolio approach. They manage pricing strategically across categories.
Trying to maintain overall value for the project.
Exactly. Maintaining their price leadership position is key. They might absorb some cost here, adjust slightly there. Interestingly, they actually decreased some promotional activity, especially on smaller garden projects, maybe to offset some tariff pressure.
Smart. Okay, so looking ahead, they reaffirmed their guidance for the full fiscal year 2025.
They did. And it's important to note what's not included in that guidance.
Right. No impact from the pending GMS deal yet. No assumptions about big FX swings or interest rate changes.
And critically, no assumption of a big recovery in large remodeling projects this year.
So what are they guiding for?
Total sales growth around 2.8%, comparable sales growth about 1%.
Okay, modest growth.
Yeah. And adjusted EPS is expected to decline about 2%, which they noted is basically flat if you compare 52-week periods.
And margins?
Gross margins flat at around 33.4%, operating margin around 13.0%, capital spending about 2.5% of sales, and planning roughly 13 new stores.
So reaffirming that guidance, even without assuming a big market rebound, that signals confidence, doesn't it?
Huge confidence. It tells you they believe in their ability to manage through this environment and
Yeah.
execute on their own strategy, especially that pro build-out. They aren't banking on external tailwinds.
Which brings us back to that positive market reaction. Despite the small misses, investors clearly focused on that strategic momentum, the execution, the pro story.
Absolutely. And the analysts picked up on it too. Morgan Stanley highlighted it was the third straight positive quarter for U.S. comps after, 8 quarters of declines?
Suggesting maybe a bottoming in housing's impact.
Or at least that Home Depot's internal efforts are really working. You saw D.A. Davidson stick with a buy at a $450 target.
And Stifel.
They raised their target to $432, kept their buy rating. They cited the improving trends and maybe some optimism about rates easing eventually.
Even global data seemed positive.
Yeah. They noted the gains were shallow but saw material strengthening. Their take was basically that the slump is finally over.
So the narrative is shifting. It's less about just riding the wave of big financed renovations.
And more about a diversified, resilient model, serving DIY well, but strategically capturing the pro market through better infrastructure, tech, and smart M&A.
An innovation-driven growth story, as they put it.
Precisely.
All right, let's pivot to our not financial advice segment. Remember, this is just for discussion, sparking ideas. Always do your own research.
Okay, got one for you. Might sound a bit out there, but hear me out.
Let's hear it. Outrageous but plausible.
Long Home Depot, and short, a basket of smaller, pure-play specialty building materials distributors.
Interesting. Why the short side?
Because of everything we just discussed. Home Depot is building this incredible, unified capability set, integrating SRS, soon GMS, with their existing stores, advanced logistics.
The ship from best location stuff?
Right. Across potentially 1,200 SRS GMS locations, plus their 2,300 plus stores. They're integrating sales forces, distribution, tech.
Create a moat.
A massive one. How can smaller regional players compete with that scale, that integration, that delivery speed? As the pro market consolidates, they're going to feel immense pressure.
And the trade credit piece.
That locks in loyalty. That double-digit lift in spend that's business potentially moving away from competitors. Home Depot can also flex its pricing muscle on tariffs because of its scale.
So the idea is Home Depot becomes the dominant force, squeezing out smaller specialists.
Essentially, yes. The market is slowly waking up to the fact that HD is playing a different, bigger game, becoming that Amazon of pro. It's a longer-term thesis on market share capture and operational dominance.
Okay, definitely plausible, even if bold. So, wrapping this up. Home Depot's Q2, yeah, slight misses on the headlines, but underneath.
Strong momentum, especially in smaller projects. Resilience.
And that reaffirmed guidance, the pro strategy advancements, the tech, it paints a picture of a company navigating challenges really effectively.
Exactly. Investors seem to be voting with their wallets, signaling confidence that Home Depot can keep gaining share and growing through its own innovation, even in a tough macro environment.
A compelling story of tactical resilience. Well, that's our deep dive for today. Remember, none of this constitutes financial advice. Please do your own homework.
Thanks for tuning in.
We really appreciate you joining us on Talk Tickers. We'll catch you next time.